Seth Kleinman of Citi joins us with his take on what could transpire today. Mr. Kleinman, good morning. Thank you very much for joining us. It's less than 12 hours to the Vienna summit. What's your sense? Will they announce any output cut? And if yes, how much?
Our sense is that you're going to get a lot of talk, but talk is cheap. The notion that you're going to get a firm, believable, plausible deal out of this meeting remains pretty far-fetched in our view. The fact is, the Saudis here, they really need to thread a very difficult needle. They need to do something big if they want to put a floor into this market, but it also needs to be plausible. And that's a very tricky combination here, because when you look around the table at OPEC, you see a lot of countries who just aren't really willing to join in a cut in a plausible fashion. Venezuela, Iran, even Iraq, etc. So we remain very skeptical.
All right. Okay, just hypothetically, if at all there is a cut, what kind of... let me take it the other way around. If, as you say, there is no cut, then what kind of lows can crude prices touch this year itself, 2014?
There's three ways you can cure the current overhang, the oversupply in this market. Okay, one is a big coordinated OPEC cut. We think that that's a very remote possibility. The other is that geopolitics comes in to bail out OPEC in the form of tighter sanctions on Iran, significantly more likely with a Republican Senate now in the United States. Things in Libya deteriorate. The situation there is very precarious. Somewhere you could see a further escalation of tensions with Russia that could potentially disrupt energy flows. So geopolitics could intervene. If neither of those things happen, and we think the first is unlikely, then you're put in a world where you need to see the next marginal barrel removed. That's the United States. And if you're talking about really curbing U.S. shale production growth, then you probably need to see WTI trading below $60. You need to get down into the low 50s if you're really going to start doing damage to the U.S. shale revolution.
All right. Just stay on for a bit. There's some disappointing news coming in. The Australian cricketer Philip Hughes, remember, he was in a critical condition in the Sydney hospital after undergoing an emergency surgery for a severe head injury that he suffered when he was struck on the helmet by a ball. And now we understand that he passed away following that head injury. He was only 25 years old, so very disappointing news coming in from the Australian Cricket Board. They have announced that Australian cricketer Phil Hughes has died following that head injury. Very disappointing over there. Condolences to his family. But Seth, just coming back to your argument about the way crude might move, in the past 6 months, crude has continued to fall despite the ISIS attacks in Iraq and the strife in Ukraine. So barring any huge war, what is your estimate for crude prices over the next quarter or two?
Well, I think that it's getting the timing on geopolitics, trying to call the timing on geopolitics is a total mug's game. But I actually think that the geopolitical backdrop here is, I think, being underpriced. Typically, when you see some kind of disruption, when you see a gunfight in the eastern province of Saudi Arabia, happened a couple of weeks ago, when you see a report in the Financial Times that the civil war in Libya is spreading into the oil patch, typically I'll get a lot of emails from clients, people want to talk about it. Now no one cares. The geopolitical backdrop is still volatile, to say the least, and I think it's significantly underpriced. So that's a problem for this market here. So you're right that there's clearly a trend. If the geopolitics don't escalate, if you don't get some significant disruption arising because of this volatile geopolitical backdrop, then we are going to have to trend lower. We are going to have to keep trading lower down into this $50 zone until you really start to curtail U.S. production. Saudi Arabia is absolutely right that it can win a price war with the United States, that it can even win a price war with the rest of OPEC. Where we think they're totally wrong is they're not going to win at 90 or even 80. We think they're going to win at 50 or 60.
Okay, I take your point, but do you think the supply cuts will not come, they may not come at $75, but maybe Iraq and Iran and other countries, even Saudi Arabia itself, may agree to production cuts at perhaps under $70, $65, you think?
Consensus is really a bit of a stretch when you're talking about OPEC. What I think you'll need to see, and sort of what our base case scenario for next year, is that prices do trade lower. That once you get through a little bit through the winter, you have a precipitous drop in prices, and that's where the panic starts. It's not about consensus. It's not about calm negotiation. It's about panic in the oil ministries and in the finance ministries of various OPEC countries. And we think prices well below the $80 level will be necessary to really prompt that kind of panic that then can bring OPEC to the table, and then they can start to pull back on production and clear up the overhang that's really weighing on this market.
So when do you see growth picking up enough to tilt the supply-demand balance in favor of oil bulls again?
Frankly, no. I mean, I think that some of the bulls have fallen back on this argument that the lower oil price will stimulate oil demand, and that can really help clear up the market. I'm not a big believer in that. I actually think that what's going on the demand side, it's a little bit cyclical. You've got emerging market weakness in Russia, Brazil, etc. But it's also structural. It's an impact of a combination of fuel economy mandates, more energy efficiency, really curbing energy consumption in oil, but also in gas and coal and everything else. It's also fuel substitution. It's the substitution of natural gas for oil, for transportation. And I'm not even including things like a Tesla electric cars, which are either a little bit bullish, a little bit bearish, sorry, or very bearish, but there's nothing bullish going on with the spread of electric vehicles around the world. So you put those two together, is I think that the macro environment is not looking terribly conducive to a big global economic growth surge for next year. And I think these structural factors remain significantly underappreciated by the broader market. I think we could be living in a world of perpetuity, which, absent an oil price collapse, the U.S. can continue to grow supplies by north of 1 million barrels a day, and global oil demand doesn't get back above 1 million barrels a day. You see the weakness in China. It's structural. It's not cyclical anymore. People are very bulled up on the Indian economy, but India is just not as energy intensive as China. It isn't now, and I don't think it ever will be because of the different paths of economic growth that the country has gone down. So India can do well economically, but it's not going to replace China, and it's not going to bail out the bulls. And when you look around the rest of the world, what are the candidates that really are, where do you expect to see this surge in oil demand growth that's going to do for the market what China did going on 10 years ago now? I don't see an obvious candidate there.
Oh, well, you're giving much more fuel to the bears than they've had so far, Seth, with your arguments. Finally, leave us with some prices. What do you think is the range and average for crude prices in the first half of 2015? And what's the range and average in the second half of 2015?
Well, we're anticipating weakness in the first half that then really does spur some of that panic that we talked about, and then OPEC does come to the table and does do something. But our general expectation, I sort of have two scenarios for oil prices for next year. I'm not dodging your question. It's a complicated world that we live in. One is that we can stabilize around this $80 level once OPEC feels a bit of panic, comes to the table, actually does something. Plus, we see some kind of significant geopolitical disruption, which has appeared with a great deal of regularity, unfortunately, for the world over the past 5 years. So something bad happens. If both those two things happen, then we're at an $80 level-ish. If neither of those things happen, then we're going to be trading significantly lower, and that's where you're looking at something like you need to probably finish the year down in the 50s if you really want to start curbing U.S. production growth, which is really what has transformed this market.
Kleinman, you will have a lot of fans in India, starting from the finance minister and ending with the Reserve Bank governor. Thank you very much for joining us with your thoughts.